We're back with your money and a big decision from the Federal Reserve.
Yeah, that's right. Announcing interest rates will remain unchanged for now, but they did signal that there's probably going to be the first hike in more than 3 years as early as next month.
So what does that mean for the economy, also your wallet? NBC senior business correspondent Stephanie Ruhle joins us with some answers. Stephanie, good morning. Everybody fears rate hikes. There's a method to this, but what does it mean for the consumer if interest rates really do rise?
Well, let's get ready, consumers. So we're expecting rates to rise next month. So if you are planning on taking out a mortgage, a car loan, if your student loans are private, right now, today, take action. Either apply to take that loan out or refinance. Same goes for your credit card debt. If you can start paying it down, do it now. Your net monthly payments will likely go up when rates go up.
All right, let's talk about investors. So how did they react to the news of this rate hike?
Well, we saw it this week. They saw this coming, and we saw a lot of volatility. Why? Well, because when rates are at zero, it's a great time for companies to grow, to operate in a bigger way, to borrow. So when rates are higher, it's tougher for them to do that. And more importantly, when rates are at zero, we all know this. As savers, we earn nothing in our savings account. So we saw lots and lots of people move their money from fixed income into stocks because that was the only way you could earn money. So stocks have been the prettiest girl in school for the last few years, and now things are going to maybe balance out a little. But for the short term, it'll be tough for stocks.
But, well, unless you're bank stock, perhaps, Steph. Hey, Steph, in the simplest of terms for folks who might be watching, why do interest rates matter so much?
They're a really important tool. Think back to when the pandemic hit. The Fed dropped interest rates to almost zero because they wanted to keep the economy moving. We were so scared. Businesses thought they'd have to shut down. Well, by moving rates to zero, it made it easier for businesses to borrow and keep their employees on. Think about how hot the housing market has been in the last couple of years. It wasn't just because people said, oh, I want to leave the city and buy a country house. It's because they could. Rates were so low, we could borrow and get mortgages at a lower rate, and that helped keep the economy going while we've had a difficult few years.
Yeah, everybody thinks of interest rates going down as a good thing, and of course raises the question why the Fed would want to raise them, and it all has to do with inflation, right?
Absolutely, because interest rates and inflation move together. It's the tool that the Fed uses to keep inflation in check. It's how they slow the economy. Right now, prices are going up, up, up all the time. And by raising rates, that's going to hopefully slow things down a bit. And I know we're all looking for prices to not go up so quickly.
Steph, you promised positive news. And when you say you're going to tell the truth, you will. So what do you have for us?
I'm going to give you two pieces.
Okay.
Well, hopefully raising rates will get the job done and we'll stop seeing prices go up so much, but it's especially good for savers. Think about senior citizens on fixed incomes. They haven't been looking to put their money in the stock market, and now those savings accounts, remember those high-yield savings accounts? We haven't seen them in years. Now you'll earn some money when rates go up, having money in savings, and that is a really good thing.
Okay, Stephanie, thank you very much. You can find more on today.com/onthemoney. Stephanie's always on the money.
Always, always.
Hey, thanks for watching our YouTube channel. Find your favorite recipes, celebrity interviews, uplifting stories, shop our favorite deals, and so much more with the Today app. Download it now.